Well, this has been a complete disaster. I don't know if you've looked at Peloton stock lately, but it's gone from being a little bit rocky, not a good year for it, to now turning into a complete dumpster fire. Let's go ahead and just look at it together. This is the one-day return. Just today, it's down 8.7%. In the past 5 days, it's down 43%. It's almost chopped its market cap in half in just the past couple days. Then if we look year to date, it's down 65%, while the rest of the market is going in the green heavily, like above 20%. So the differential between Peloton and the S&P 500 has been very wide, and Peloton investors, I think, are feeling a lot of pain right now. Now, I made a video about a month back of why I'm selling completely out of Peloton. I changed my mind on the stock. I realized that the story is not playing out. I wasn't predicting a 40% sell down. This is not something that I predicted, but it doesn't 100% surprise me. This isn't exactly shocking because I saw some warning signs, some real material changes with the story of this company. And what I'd like to do in this video is just do a look back. Overall, the story of this company, what was the good side of it? What was the initial thesis? And then where things went wrong and how we can learn from this. How we can avoid this type of thing happening with other investments. Now, one of the interesting things about the stock Peloton is even though it's down 65% year to date, I managed to walk away with 100% returns on this stock. And maybe that's lucky, maybe it was just fortunate timing, but I think some of it had to do with just looking at the situation and making rational decisions. For instance, when I initially bought into Peloton, it was around $65 a share. So I bought in right around here in 2020. The initial research was basically that the stock was trading at around a $17 billion valuation, right? That was the market cap of the company. And I saw a lot of other companies priced much higher. And at the time, Peloton had a ton of demand. The demand was huge with Pelotons. Like people could not buy them. There's a huge wait list. I saw that people were getting them delivered like 2 or 3 months after they ordered. Their social media accounts were exploding. And I was like, wow, they're really onto something. Plus, they're not only selling these devices, but they also have the subscription revenue that they're selling all the time, and they have record low churn. So the story looked very strong. The demand was there, the high price was there, the brand value was there. The stock quickly raced up double what I paid for it. And I bought like $1,100 here and I sold $1,000 here. That's where the 100% gains come from. I still had maybe $500 a Peloton, and I just made sale after sale, shaving off $50, $100, because over time I became far less confident in the story going forward. Over the past year, Peloton has ran into things that I don't think are superficial. I've shown before my chart of things that are superficial and things that aren't superficial, or I call it long shelf life and short shelf life stuff. In fact, I might be able to bring that up here. Let's go ahead and look at this. This is the shelf life of different things that affect stocks. We have short shelf life stuff, CNBC pundits, quarterly earnings, politics, scandals, YouTube clickbait. That's stuff that you can probably safely ignore, and it's really not going to have that big of an effect on the stock. Long shelf life stuff is the leadership, the moat, the valuation, the fundamentals, and the growth prospects. With Peloton, there was multiple things happening to the company that I think fall firmly under the long shelf life category. First of all, the moat. Peloton's moat was being invaded by a number of competitors. One of them was Apple with the Apple Fitness, right? They're doing that. Now I can work out on my treadmill. I have my Apple Watch and I can track my workouts there and I can watch it on the TV if I want, right? Apple has basically made it so that their watch is the Peloton device and you can work out doing anything with it. That's just one competitor, but that's not the only one. There's echelons. I notice them in Costco's all the time. Costco doesn't carry things that don't sell. If they don't sell, Costco will not carry it. So Echelon obviously saturated a huge portion of the market with their Peloton knockoffs. And then there's iFitness, or there's all these different types of fitness things that you can work out and see yourself like hiking through the woods and stuff. There's people that simply work out on treadmills or bikes and they use iPads and watch Netflix, right? I just saw that the moat wasn't quite as strong as I initially thought. The moat initially was that they have the high quality brand value, and the brand value also was in trouble. So we have the moat being invaded. The valuation was trading at an extremely optimistic valuation earlier this year. It was priced to perfection. And so you have to look at that. If you have companies that are being priced to perfection, they need to perform better than perfection. Many of these companies can. Many of these companies are so good that they outperform even their extremely lofty valuations. For instance, Google was priced to perfection earlier this year, and it outperformed vastly. It grew its earnings way faster than even the most optimistic expectations. Some of these companies are so incredibly powerful and so good that they will perform almost perfectly or better than perfect. But if you have a company like Peloton that was priced to perfection, trading at a $60 billion market value, it better perform well. Everything has to work out almost perfectly. And that didn't happen. The valuation was extreme. The fundamentals were getting deteriorated, and I could tell that they were deteriorating. Now, there's a couple reasons why I cited as where I thought Peloton's story was materially changing, meaning there was real effects that would affect the long-term future of this company. One of them was regulations and government issues with recalls and fighting the government, and another one was the price cuts. And I actually think that this was a bigger issue because to me, as someone that studied Peloton early on, the big thing they had going for them was this incredible amount of demand. And when I saw that they were lowering the prices, I thought, wow, they're already out of demand. Like this pandemic opening and the economy opening is affecting their demand way more than I thought. I thought they'd still have demand for like another couple years at least, but they're already showing with the price cut that they no longer have demand. They're trying to sell these things and they can't sell them quick enough. So this was something that I highlighted. In fact, let's go ahead and take a look at the episode 1 month ago where I share this exact concern. Now, the second reason why is the price reduction. This was a major red flag for me. When I saw this news, I was not very happy about it. It's true that they'll get more of them sold and they might have more subscription revenue, but the price reduction is a huge deal for a premium company like Peloton. They say that Peloton hopes the bike price cut and the cheaper treadmill will lead to more Peloton households. The problem with this is one of the main reasons that I highlighted for buying Peloton was the massive demand for Peloton. They couldn't keep up with demand. Well, obviously, with the price reduction, they're saying, yeah, we can keep up with demand. In fact, we're not selling them fast enough, so we have to lower the prices. That's not good. That means that now the actual productivity of the bike, actually producing them, outweighs the demand. They no longer have the demand to match their production of the bikes. And to me, that's a red flag. The price cut may have seemed like something insignificant. A lot of people just passed it off as business strategy. Oh, they're just cutting price to saturate the market. But doing it so quickly and such an aggressive price cut, to me was a major red flag. I didn't feel good about it. I thought that they're not selling their devices as fast as they want. That's the reason that they're cutting the price. If they still had the enormous demand that they used to just 6 months ago, then there would be no price cut. There'd be no reason for them to do this. So that was a huge red flag in my opinion. And this is what that last earnings report showed. They said that Peloton shares fall 25%, that was widened to 40%, as the company posts wider than expected losses and slashes full year outlook. There wasn't much good in this report. Like everything was almost bad across the board. But one thing that they specifically highlight is the company slashed its outlook for the full year amid softened demand for its exercise equipment. This was the result of them lowering prices. They had softened demand. They couldn't sell enough devices. They showed us that beforehand by lowering the prices. Now let's talk about demand here for just a minute. We can use the example of Apple. This is a company that's kind of like Peloton in that it sells high quality hardware with software attached to it and subscriptions attached to it. But Apple, unlike Peloton, doesn't need to lower its prices to try to sell their product. In fact, Apple can continually raise their prices year over year. Their new phones are like $1,000 or $1,100. I'm sure that's more expensive than they were a couple years ago. They're not getting cheaper as time goes on. They're getting more expensive. We can look at their brand new MacBook Pros. These came out and people were a little bit caught off guard on how expensive these are. The MacBook Pro 16-inch is $2,400. We can look at this one. They even break it down into different categories, and some of them are up to $3,500 for a MacBook, $2,700, $2,500. This is for a laptop, and people will pay it. Apple doesn't have any issues with demand for their product, and you can tell that by the fact that they continually make sales while increasing the price for their product. They don't have to lower it. They don't even have to keep it the same. They can increase it, and they'll still have incredible demand. Look at the AirPods. This is an increased price year over year from the last AirPods. The AirPod 3s are $179, and they'll sell every single one of them. These will be sold out of stores before Christmas. See, this is what demand should look like. Being able to charge more for a product, not less, and still having people lining up at the door to buy each and every one of them. Apple has demand. And there's even articles written questioning why AirPods are so expensive. Why are they so much more than other knockoffs or different alternatives? Because Apple can sell them. That's the reason why they're so expensive. Apple can sell them. They have demand. We can take another example, which is Tesla. Tesla obviously has more demand than they do supply because they're raising prices. And there's no reason that they'd raise prices if they couldn't sell their vehicles. So this is a company that has a good problem. It has too much demand. And as long as Tesla can keep that, their sales will probably be great. As soon as they start lowering prices and offering discounts and promotions, and they're looking for ways to sell vehicles that seem a little bit desperate, that would be a huge red flag. I don't anticipate that from either of these companies in the future. So I think the story of Peloton overall, and what we can learn from it, is to keep track of your investments and see if the original thesis you had is playing out like you anticipated. And if it changes, don't be glued to your stock. Be willing to adjust and admit that your original thesis was wrong. With Peloton, my original thesis was wrong. I thought the stock would continue to have demand. I thought the products would continue to sell. They weren't selling. They were lowering prices. It was clear to me that demand was an issue, and that would be an issue with any company. If Apple couldn't sell their products, I'd become very concerned. I would no longer invest in that company. If I went to Costco and I noticed that it was just empty all the time, there's a bunch of empty checkers, no line out the door, no people funneling into the warehouses, and I went a couple times and I noticed that it was like empty all the time, I'd become concerned with Costco. Of course, it's always packed, so I'm not concerned. I feel very confident in my investment because every time I go to any different Costco, it's completely packed. If I noticed that YouTubers were all leaving to a different video platform, I'd be concerned with the video platform of YouTube and the future of Google. I'd be concerned with Spotify if their growth was slowing down as a result of Apple Music. So obviously this isn't really any unique or incredible way of looking at a company. It's simply just keeping track of the story, making sure it's evolving how you're expecting, and if not, move that money into a company that is, because there's lots of good companies that are really firing on all cylinders. I can name off a bunch of them. You don't need to speculate on companies that are really struggling when there's so many better options. But that's my thoughts and a quick follow-up on Peloton. I'll see you all in the next one.